On March 18th, Atanu Chakrabarti, the chairman of India's second-largest bank, submitted a vague resignation letter stating that certain internal practices conflicted with his personal values and ethics. The consequence was swift and brutal. The very next day, HDFC Bank's stock crashed by 8.7%. That single session wiped out 70,000 crore rupees in market capitalization, dragging the entire Indian stock index down by more than 3%. Then came a massive contradiction. Almost immediately after the crash, the chairman went on national television to walk back his own letter, claiming there was absolutely zero wrongdoing at the bank, only minor ideological differences. Investors hate bad news, but they panic over uncertainty. Writing values and ethics in a formal letter and then brushing it off on television created a complete vacuum of information, spooking investors and driving the stock straight to a 52-week low. That resignation was entirely a symptom of a deeper disease. The market crashed because HDFC was actually hiding two massive vulnerabilities beneath the surface, a devastating breach of client trust and a structural mathematical nightmare. To understand the trust deficit, we have to look at AT1 bonds. Think of a bond like a standard loan you give to an airline to buy a plane. In a standard bond contract, the rules are rigid. The airline pays you a low interest rate, guarantees a specific end date to return your capital, and if they go bankrupt, you're given top priority to be paid back from whatever assets remain. This diagram compares that standard loan to an AT1 bond. The standard contract has a clear end date and a guaranteed return. The AT1 contract is an infinite timeline offering a massive high-yield interest rate, but it features a trapdoor. If the institution faces an emergency, your entire investment can legally be written down to zero. HDFC's Dubai branch exploited the bank's highly trusted reputation to push high-risk Credit Suisse AT1 bonds onto non-resident Indian clients. Executives marketed these as completely safe investments, promising massive 10 to 13% returns, without adequately disclosing that hidden trapdoor. The trapdoor opened in March 2023, when Credit Suisse suddenly collapsed and required an emergency rescue by UBS. Looking at the bops, Swiss regulators legally ordered a complete $17 billion write-off of those AT1 bonds. In a matter of minutes, the investments held by HDFC's NRI clients were entirely erased. For HDFC, the fallout was catastrophic. They took their most lucrative demographic and burned them on an incredibly risky asset pitched as a safe harbor, destroying their reputation as a reliable steward of wealth. While the bank was losing trust abroad, it was breaking its own mathematics at home through the 2023 mega merger with HDFC Limited, its massive housing finance sibling. The core engine of any bank's profitability is its net interest margin. This is simply the spread between the cheap money it takes in as deposits and the expensive rates it charges to borrowers. Current and savings accounts, known as CASA, are incredibly cheap for a bank to maintain, costing only about 2 to 3% in interest. Fixed deposits, or FDs, are highly expensive, requiring the bank to pay out around 7%. This diagram shows a simplified 100 rupee model of HDFC's pre-merger state. They maintained a perfect equilibrium, 50 rupees of cheap CASA deposits balanced against 50 rupees of expensive FDs. Because the average cost of their money was low, they easily generated a healthy 5% net interest margin when lending it out. When we apply the shock of the merger to the model, the math shatters. HDFC Bank inherited a massive home loan book from HDFC Limited, but almost no cheap CASA deposits came with it. To fund all those new loans, the bank had to rapidly flood its balance sheet with expensive 7% fixed deposits. The real-world consequence was severe. Dragged down by the sheer volume of costly deposits, HDFC Bank's net interest margin collapsed from a robust 4.1% down to a highly concerning 3%. In the pursuit of massive scale, HDFC broke the carefully calibrated deposit-to-loan ratio that made it so uniquely profitable in the first place. But the margin collapse wasn't the only mathematical penalty. The merger triggered a massive regulatory hurdle based on the difference between an NBFC and a commercial bank. Before the merger, HDFC Limited operated as a non-banking financial company. That status gave them the freedom to lend out nearly 100% of the capital they raised from the market. Commercial banks do not have that luxury. the central bank enforces rigid safety buffers, known as the cash reserve ratio and the statutory liquidity ratio, to prevent bank runs. This animation shows exactly how that compliance functions. For every new deposit HDFC takes in, they are now required to lock up 21% of that cash safely with the RBI and in government bonds, earning almost zero interest. Because of the massive size of the inherited loan book, this rule forced approximately 1.3 lakh crores of capital to sit completely idle. Stripping that much lending power away drove HDFC's loan-to-deposit ratio up to a dangerous 100%, placing them well outside the central bank's safe comfort zone. The merger incurred a massive hidden regulatory tax, trapping billions of rupees in dead weight on the balance sheet. Trapped capital, crushed profit margins, and the unethical sale of high-risk bonds are not isolated incidents. They are overlapping failures happening exactly at the same time. Compounding these internal failures is external pressure. The bank is trying to fix its foundation at the exact moment global markets and geopolitical tensions are already weighing heavily on investors. Because in the global banking sector, public trust is the literal currency required to keep the mathematics functioning. When a financial institution scales too fast, dilutes its core deposit base, and burns its most loyal clients for short-term yield, both the mathematics and the trust fracture simultaneously. HDFC Bank is now racing against the clock. They have to prove to Dalal Street and their own depositors that they can repair both their balance sheet and their reputation before the market permanently prices in the damage.